What's up, y'all? Welcome back to the third episode of our accounting series. As always, our past videos are in the info card above, and we have a new playlist on our channel where we're going to be featuring all these accounting videos, both the current ones and the future ones.
We're releasing new videos every week on Monday to cover all the curriculum before the end of the year, so be sure to subscribe to those so you know when new episodes drop. Now let's dive into Unit 3, Accrual Accounting and Income.
Alright, so we've done examples in the past where accrual accounting was involved, but to give a concrete definition, it's essentially something that records the impact of every transaction when they occur. Now, there's a big difference between accrual accounting versus cash-based accounting. Accrual accounting records both cash and non-cash transactions, as well as income and expenses when they are incurred. This provides a more complete definition of a business's financial statements.
In comparison, cash-based accounting records only cash transactions when they happen, just the receipts and payments, and as a result, it ignores important information and it results in incomplete financial statements. You can see here it only tracks the cash and it only records when the cash is received as compared to accrual accounting, where it records the actual time of the actual transaction that's taking place. There is a reason that accrual accounting is required by the GAAP as well as used by the vast majority of businesses. Accrual accounting also uses the time period concept, which ensures that accounting information is recorded at regular intervals. The basic period lasts 1 year, but companies can also provide interim statements at less than 1 year. Usually, the accounting period starts at the start of the calendar year, January 1st.
So this might seem like common sense, but the revenue and expense principle basically states that the revenue expenses are to be recorded at the correct amount at the given time that they occurred. In addition to this, when we are calculating expenses, we have to make sure that they're in the same period in which any related revenues are earned to be able to actually calculate net income or net loss accurately.
Sometimes adjusting entries are needed in the accounting journal. For example, when a business needs to pay a partial amount of rent in advance, or to report depreciation of a plant asset, etc. Those are still necessary transactions, so an adjusting entry is needed. There are three main categories of adjusting entries. Deferrals, which show advance payments of an item of cash received. Depreciation, which decreases the value of an asset over its useful life, like a car or a plant. And accruals, which are the opposite of deferrals. Let's explain each type in more detail.
So deferrals come in the form of prepaid expenses like prepaid rent or an advance payment of cash. For example, paying 3 months of rent So deferrals come in the form of prepaid expenses, like think about prepaid rent or a payment that you make in advance of cash. So for example, that paying 3 months of rent in advance would be a great example of that. And so these are actually considered under assets because even though they aren't necessarily being exchanged for something tangible, they are still providing a future benefit to the owner.
So the main type of deferral is a prepaid expense, and they are first recorded as a debit in the journal, and they are counteracted with a credit in cash. Now, when the expenses actually occur, it's under this later tab, an adjusting entry is required to transfer the prepaid expense to an actual expense. So expenses are debited and prepaid expenses are credited. Essentially, this is like that temporary account that is being closed. This is important to understand, as using the principle of expense recognition, we record expenses on their actual date. So 1 month's worth of rent is expended on the 30th of each month.
Depreciation is mostly used with what we call plant assets. So these are things like land, buildings, furniture, equipment, etc. And depreciation basically allocates the cost of the product over its useful life. And this goes to demonstrate the fact that a product declines in value the longer it's being used. So for example, a car worth $20,000 right now might only be worth $5,000 5 years from now. Obviously, this is because the parts get older or less reliable the longer it's actually in use. And this is the reason why we need to record depreciation. Even though it doesn't relate to an actual cash payment, it's because its decline in the value of an asset makes it worthy of recording it on the balance sheet.
The most common method for recording depreciation is the straight line method. Don't worry, we will cover other depreciation methods that are used, but the most common and most easily used one is the straight line depreciation method. Essentially, the value of the asset decreases according to a straight line slope where the cost is allocated over its useful life. For example, the car that costs $20,000 today might have a useful life of 20 years. So it would depreciate by $1,000 a year, which comes out to around $83 a month. The way we account depreciation is to credit the accumulating depreciation account and debit the depreciation expense account. This happens after we record the decline in value of the car and add it to debit the accumulated depreciation account. This is an asset because it allows the owner to derive future economic benefit from this resource. However, its balance is recorded as credit, so it's considered a contra asset account. A contra asset account always has a companion account. In this case, it's a depreciation expense, or debit. And its normal balance is opposite the companion. Notice how these amounts are always going to be the same every time depreciation is recorded.
Since an accrual is the opposite of a deferral, their definition is basically just the expenses or the revenues that have not yet been paid or collected. Now, there are actually three main types of these to keep in mind. The first is accrued expenses, and that's what we're going to discuss right now. So accrued expenses are liabilities that come from expenses that have not been paid yet. As such, they initially credit the payables account and debit the expense account. And once the official cash transaction is made, then the payables are debited and the cash is actually credited. Some examples of this include salary and income tax payments.
The next type is accrued revenues. They're revenues that are earned but not collected. As such, they're still considered assets, but they don't have a correlated cash payment yet. To account for them is the opposite of accrued expenses. So, first, receivables are debited and revenues are credited. Receivables, once again, is an asset account. Once the cash payment occurs, the receivable account is converted to cash and cleared. And yes, the receivable account is credited and cash is debited. Closing an account basically means that the balance is cleared. Accounts like receivables and payables are meant to transfer to real cash collections and payments. So previous example, the receivable accounts was cleared and closed. Okay, so the next type is unearned service revenues. This happens when a company receives cash before earning the revenue. In a sense, it's a prepaid as cash comes first and then the revenue, and then the action is conducted. So at the beginning when the cash comes in, cash is debited and unearned revenue is credited as the service hasn't finished. Later, once the service is completed, the unearned revenue transfers over to the revenue balance. This is a bit of a tricky topic, so here's an example. So let's assume Disney World Resort pays our travel company $400 a monthly if it books up to 8 clients for the resort within a 30-day period. If our travel company collects the first amount on June 15th, the transaction occurs as follows. So we get the cash first, which is an asset account, and since the service hasn't been completed, unearned service revenue is a liability as shown. This is an asset A and this is a liability L. So cash is debited and the liability is credited. Now, during the last 15 days of the month, Aladdin Travel books 4 clients and into Disney World Resort to earn half the $400. Since it's at the end of the month, June 30th is going to be recorded again. This is our second entry. So unearned service revenue is being converted into revenue. So unearned service revenue is decreased or debited by $200, and service revenue is being credited by $200. So that just shows like this is a partial payment. Like the full $400 hasn't been converted yet to revenue. But since this is something that was done before the end of the month, that's why this is recorded, because it's recorded at the time when the transaction happened.
So in summary, these are all temporary accounts that are created with the intention of converting the cash when the service is actually complete or the transaction actually occurs. So with these adjustments, an adjusted trial balance can be constructed, which can allow for the construction of financial statements for that period. So closing the books helps prepare accounts for the next period. Temporary accounts like revenues, expenses, and dividends only relate to the period. So they are actually aggregated together to form the income statement and the statement of retained earnings. Now, this processes the outputs for the net income for the period and the ending balance of the retained earnings account using the formulas mentioned that we talked about earlier. Permanent accounts like assets, liabilities, and equity are actually not closed.
So these accounts, essentially, they are they're combined together to get those big measurements of revenue, expenses, dividends. These are also temporary accounts that help form the financial statements. These are zeroed out and cleared so that the next year can start. So assets and liabilities can be classified into current and long term based on liquidity, which is basically how fast an item can be converted to cash. You might have heard of the term of a company going liquid. That means that it's going out of business and is seeking to get cash from its assets and liabilities, or liquidation. For example, cash is the most liquid, and receivables are relatively liquid. They only have a short time before converting to cash. Physical items like inventory, equipment, and buildings, which are called plant assets in accounting, are less liquid, since they need to be sold for the revenue to be extracted and to convert it to cash. So current assets and liabilities are relevant within the next year, like cash, short-term investments, receivables, and then for liabilities, payables, unearned revenues, and notes payable within the current period. Notes payable like bonds, loans, etc., they often last for multiple years at a time. So the current payments for this year are recorded as current assets. On the balance sheet, those are separated between notes payable in the current period and long-term notes payable for the rest of the period. The long-term assets and liabilities, they take the form of planned assets and, like I said, long-term notes payable. They cover everything else that's less liquid.
Now, this is the core of financial analysis, using available financial statements and relationships between accounts to actually draw conclusions about a business's health and flexibility and success. There are three main ratios that can be used and derived from the balance sheet that actually give us insight into the company's debt-paying ability. The first being the net working capital. Now, what this means is that it's the operating liquidity which shows the ability for a business to pay off its current liabilities with its current assets. Now, we know that the total assets have to be greater than the total liabilities, but the proportion of current to long-term can actually vary. And so the formula for net working capital is total current assets minus total current liabilities, or the excess of current assets over liabilities.
So the current ratio also represents operating liquidity, though the formula is a little bit different. It's total current assets divided by total current liabilities. This effectively normalizes the current ratio so it can be compared across multiple different businesses. So, and many successful businesses operate with current ratios around 1.2 to 1.5. The higher the current ratio is, the better, because it's more flexible if it needs to pay off liabilities really quickly. And if it dips below 1, that's a sign of real concern, because current liabilities will then exceed current assets. The next ratio is the debt ratio, which again kind of shows debt paying ability. And it's calculated by total liabilities divided by total assets. The difference is that this is the total liabilities divided by the total assets. So we're accounting for current and long-term together. Basically, it's the proportion of total assets financed by debt, and the lower the debt ratio, the better.
And there you have it, guys. That's episode 3 in the books. That was a little bit more detailed than the previous videos, and so in the next videos we're going to be going over more specific types of assets, liabilities, equities, and things like plant assets, inventories, receivables, payables, and lots more. So stay tuned for our upcoming releases by subscribing to our channel and hit the like button down below, and we'll see you in the next one.